Thanks a lot, Danny. Can you guys hear me? Okay. Got it. 1 second. I'm going to get the other room in the right one. Okay, great, guys. Okay, I think I'm pretty set up. I'm going to... Okay, here we go. Anyway, yeah, thanks a lot, Danny. Thanks a lot for John and also Marlon to help me get hooked up here. That's always fun. My internet literally went down 20 minutes ago for the first time in 3 months, so thank God it came back on. In any event, I'm not sure. Here's the first slide, just a little bit about of my background. I come from the buy side and worked for a few hedge funds. Started in the late 80s, and now I'm just managing my own money, and I'm helping other high net worth individuals. Okay, so here's the, let's dig right into it. One second. Okay, I'm back. So the first chart is the monthly S&P 500. I like to start with the big picture look, and then go down. And unlike a lot of the traders in the room, I'm definitely a position trader, longer term, swing trader. I like to hold my trades for several days at least, can be longer. And I also do use the options arena, SPX, sometimes to hedge the S&P, the ES. And so here's the monthly chart. And basically, I just wanted to show a few things. First, you'll notice the late 2017 ramp into early 2018. You see, it was this is the RSI down here, the blue line, and it was a major ramp. We haven't seen that since 1995. So that, you know, with the tax reform, that basically gave us that blow off top, and then the rest is kind of history. I put some green arrows here. And the one on the left here, that's 2009. That's kind of the explosive, I want to say breadth thrust that that basically kicked off the current bull market that we're in. And recently, on January 9th, we actually had a similar breadth thrust. And I'm going to talk about that in a couple of slides in the future here. But we had one there at that time period, and we also had one in early 2016 in the March right here. There was another breadth thrust, and it began a nice move up, obviously. And I just show I've got the stochastic here. You know, some people use that. It's kind of, it just crossed up and back in the positive side. Okay, the second slide is basically the 1990s bull market. And the main thing I just wanted to show here was, if you see down here, 1998, we kind of had this 20% decline. It happened pretty quickly over a short period of time. And a lot of people are thinking that the current market environment and the current trade could be similar to that back then. And I think that's a possibility. But there are a few slight differences. The main one is, if you look over here on the prior slide, we got actually all the way down to 50 period monthly average, and on this one we got to just the 20-day. Excuse me, the 20-month. So it kind of wasn't quite as deep as the one we had in late 2018. Otherwise, this move right here, all the way up here, lasted obviously another year and a half or so, and it was around the 31% move, and it would put us roughly, I think I calculated 3,800 if we did the same exact thing. So that's kind of the bullish case, I'd say. The next slide is just I just wanted to, I really think that a lot of the dramatic fall that we had was exacerbated uh, in large part by the fact that the Powell, there really wasn't a Fed put last year. If there was, the strike price was down at, say, 2000 or something. Um, he spoke very hawkishly in October, and that really started the down move. And again, in that, excuse me, the Fed meeting in early December, when he was also pretty hawkish, said we're on an autopilot, and the market didn't really want to hear that. So that started, I think, roughly an 8-day huge down move, and got us to where we're on Christmas Eve. And basically, where we are now, after the 20% sell-off in late 2018, and then we had a massive breadth thrust rally over the last several weeks. The S&P 500 is short-term overbought and near previous important resistance levels at 2810. This has historically caused some near-term headwinds and a pause, but as you will see, there is still plenty of healthy skepticism by most investor classes. So my conclusion is that in March, we're probably going to enter a little bit of a consolidation if it's like some of the past markets, and then make another run towards 2,900 plus in the late spring or early summer. And I do believe that the future rhymes with past cycles. And we'll show you some similar overbought markets after breadth thrusts and how they ended up playing out. Nothing is exact, but you can get a good idea and make an assessment that certain things may happen, and you got a good chance of success. The first signals I want to show you are some momentum and breadth signals. Some of you guys maybe have seen this on the internet. I posted some of the stuff in the room. And the first one, the major thing that happened off the bottom was we had this breakaway momentum signal. And as I said, some people call it a breadth signal, where essentially for 2 weeks, for 10 trading days, if the up volume is 1.7 times the down volume, then you get something called this breakaway momentum or breadth up thrust signal. And it doesn't happen that much. It happens every 3.5 years or so. And wait, let me make sure you guys can hear me. Can you guys hear me? Can you guys hear me? Somebody types in a yes. Okay, cool. Thanks, Christine. So this is an important slide for, I'd say, the intermediate to longer term. If you look over here on the right, basically 2 months after the signal, generally the median gain is 5.9%. And that puts you right at around, I calculated the other day, let me get it, should be 2737 is normal on March 9th. That's a 2-month result. Then generally after you get to the 2-month time period, it kind of stalls out a little bit. You have this really big breadth thrust. You'll see these numbers for 1 week, 2 week, 1 month, 2 months, 3 months, and then 6 months. As we get into 2 months, the median is 5.9%. Then it jumps up to 7.4% at the end of 3 months. So it slows down a little bit. It's only about up on average about 1.5% from between months 2 and 3. Now, it's not always exactly at 2 months. It starts to go down. Sometimes it goes down before then. Obviously, you see some red up here, but it gives you a good general idea. The interesting thing is if you look out 6 months, it really starts to blow up again, and it goes from 7.4% as a median up to 11.8%. And then the 1 year after you get the signal, which would be January 2020, you're up 18.6% on average. And you can see down here are the positive out of 22 signals, it was a 95% rate. So that's pretty darn good. And this bottom chart just shows you the general path. Once you get the signal, what happens? And it's the gold line is the median, and the blue line is the average. But they generally go from left to right, upper right, as Dennis Gartman likes to say. So I think that's one of the more statistically significant things that happened, and it's not just this particular indicator. Several others, and I'm going to show a few others, show similar things, that this was kind of a very positive move off the low. And I was not expecting a V bottom. I was totally looking for a W bottom. So it took me a little while to get back in sync with it. I did okay at the low, but I got out a little bit early and then had to chase a little bit. And so that's where we stand right now. But that's one of the most important slides. The next slide is what happens basically when you have a large downdraft and then you come all the way back to the 200-day moving average. And let's see here. Sure, I got on this other screen. Okay. You'll see that the near-term results, this is as of February the 12th that this was calculated on, but we're above the 200-day moving average, as most people know by now. Usually, you can get a little bit of a pause. You'll see some red over here. The next, the first week it averages up another 1.44%. And 2 weeks later, it's 1.42%. And you go 1 month later, it's 3.3% basically. But the interesting thing is you can't, the first one number is blocked out, but these numbers continually get higher as you go out in time. You'll see a 77% chance a month later, 92% chance 2 months later, and 3 months later, it's every time it's been up from where the buy signal was. So that was in the low 2700s from last week. But again, you'll see, there's a lot of green over here. So that's obviously very positive and bodes well for the longer term. Short term, not so much. You start going out 6 months, though, in 3 months, 9 months, very good number, solid. Okay. So the next slide. One second here. Okay. Okay, the next slide. Okay, so we had a huge rally off the low. This slide, all it's saying is the market has rallied 15% over the past 33 days while experiencing 2 or less 1% daily losses. So really small pullbacks. I mean, considering the gains and the volatility we had in late December, it's a pretty amazing feat the way it's gone straight up and caught everybody off guard. But you'll see that generally there is a little bit. Again, this was from late last week or mid last week. The signal was triggered, and 1 week later, you're actually down most of the time, 0.5% on average. 30% of the time, it's positive. And 2 weeks later, it's a little bit better, but still about a coin toss. And there were a lot of years that we did pause. And right, just as an aside, I think we're pretty close. I think we're probably going to have a little pause right here, and then another move up to perhaps a little over 2,800, and then a longer term move, probably starting in March, as I said earlier, where I think we're going to end up being in some sort of a trading range, 28.25 on the upside and maybe 26.75 on the downside till April or May. But back to this particular slide, 1 month later, this has you're up 95% of the time on average 3.38%. 2 months later, you're always up according to this particular indicator. I noticed that there's some overlaps. There are a lot of signals that are roughly the same days, near the same date. So that's a little bit of the sample size here is actually pretty small when you consider that. This because it's one in 1955. So I would take this one up with a little bit of grain of salt. But the general picture, the further you go out, 6 months later, I mean, you get some really nice moves. And a lot of people, since we talked about 1998, here are some of those days in 1998 that we talked about. And we got the breath signal. And one thing I didn't show you on that, let me go back up here to the breadth thrust. I did want to point out we had this breadth thrust in basically in March of 2009 and also in March of 2016. So I just wanted to highlight that because those are the 2 years, those in 1998 that I did key off of and focus on later on in the presentation because they had these huge breadth thrusts, and it's a similar scenario now. Okay. The next thing I want to talk about, since I'm really big into investor sentiment and positioning, I want to show some slides that will tell you kind of how much fuel is in the tank. Are investors complacent? Are they bearish? Are they cautious? And I'd say they're still cautious, even though we've had one of the biggest moves in a long time off a low. Investors are definitely cautious. Here is the CNN Fear Greed Sentiment Indicator. I posted this last year in the presentation, and because I think it's a good indicator because it combines several sentiment indicators into one, and it gives you a good broad idea of what's really going on. So it's got some put call information. It's got the VIX in here, junk bond demand, stock price momentum, like it's the S&P 500 versus its 125-day moving average. So as you can see, we're pretty overbought here. You know, we had this huge move off the lows and we're overbought. The interesting thing is normally when you get this overbought, you have a bigger pullback. And the fact that we haven't is a longer term, that's a very good sign that there's a lot of underlying strength. When you rally in the face of overboughts, like last year when we got up here at these levels, you'll notice that the market generally paused. And this year it really didn't pause. So that's a good indicator that we're probably, if we do pause here, like I think we may have a brief pause starting in the next few weeks, we probably will continue this trend up, and we'll have to determine how high we get. I'll try and give you some ideas later on that. But I just wanted, this is a good chart. You can also type in CNN Fear Greed into the Google search engine, and you can find out information about it, more information, how they construct it, and you can get the daily indicator. This is from sentimenttrader.com. I highly recommend their service. It's only 39 bucks a month or something, but they've got several hundred great sentiment indicators, graphs. It produces a daily report. It's very timely. Most of the top players on the street actually get it. In fact, sometimes it's amazing because the report comes out right around 6 o'clock, and depending upon if he's bullish or bearish, the E-mini, the S&P moves up or down depending upon if he's real bullish or bearish on any given day. So he's also on Twitter, and I have some follows for you later, some will follows you may want to take a look at. Okay, so let's go to the next slide. Okay, here's a slide of this is from this. It's also from Sentiment Trader, but what he does is he goes to the CFTC, gets all their data on the index products, the NDX, the S&P 500, and the Dow futures. And what he does, he comes up with a smart money indicator. When the commercial hedgers are more bullish than they are bearish, he sees that as a positive sign, and I do as well. So he created an indicator that when they are the most bearish, for example, in the past year, excuse me, when they're the most bullish in the past year, they're below the green line when you score 100. And recently in mid-January, we scored 100 on this. And we did after the little bit of a crash last year. But it was a great time to buy last year. And generally, you'll see over here in 2016, when you get near 100, it's generally, they're considered the smart money and you want to go with them. And right now, I'm going with them in the longer term. You want to be a bull. Okay, so where are the retail investors? The retail investors they're more cautious. They sold a ton of mutual funds and ETFs in December, actually $46 billion worth in December. And that was the biggest week ever in mutual fund sales. And lo and behold, the next week the market bottomed, and there, we rallied almost 20% off the lows. The other interesting thing that I see here is that even though we had this nice move back up, there really hasn't been huge participation. There's none of these big bars up, yet. So I would classify them as definitely cautious to even bearish, and that's a good, another healthy sign. So these two specific charts, the CFTC chart and also the mutual fund flow with ETFs. I'm a contrarian. I think these guys are wrong more than they're right, especially at extremes. So I think it's a favorable outcome longer term for the market. You don't want to you don't want to be on the side of the retail investors. When they're selling down here, you want to be buying. Here's another retail sentiment indicator. This is the TD Ameritrade IMX index. And basically what they do is they have all these clients and they, like Big Brother, they monitor them and they come up with their own sentiment index. And recently, if you look over here, let's see. If you look over here on the right, you'll notice there's no data. The scale isn't correct, obviously. Unfortunately, it didn't come out that good. But on the right-hand side, you've got, whoa, this is the January move. The S&P 500 was up large. And the sentiment index actually, they got more bearish, even though the S&P, I think, was up about 8% in the month or so. In January, they got more bearish. That was definitely the first sign for investors that the rally was probably going to continue in February. We'll see if they tick back up in the next reading, but it was definitely a wake-up call. And if you were short or not long, that was like you got to cover or try and get a little bit of exposure. So the retail investors from those last two slides, they're cautious. So sentiment is definitely constructive. And here's the next slide. I couldn't find a chart. I was really looking hard for a good chart, but I really couldn't get a good one. So this is basically hedge funds. Are they underweight or overweight equities? And right now, the hedge funds, like retail investors, they're way under invested. As of last week, they basically were the rolling beta, which basically means how do they perform versus the S&P 500. If the S&P 500 goes up 1%, what is their hedge fund going to do? And generally was only moving 0.36%. So that shows you that their exposure to equities is very low relative to where they were last September. Last September, S&P 500 went up 1%. They would go up 0.81%. And now they basically get a third of that. Neutral, I guess, is probably somewhere around 50%. So we're still under that particular benchmark. So those guys are still chasing it. And the pain trade is still up longer term. The same thing with the macro hedge funds. According to this last week, they were only in the fourth percentile, which means that they were way under where they needed to be invested. Otherwise, their competition or the competition in terms of the market was going to crush them, and they may lose their jobs. So they got some catching up to do in explaining to the customers. The other kind of hedge fund is a long-short hedge fund. And the rolling beta there was 40th percentile since 2003. Not as low as the other ones, but they still were a little bit under what they normally would be. And the last one is there's the way to track mutual funds. And they're performing in the 33rd percentile since 2003. So again, they're under where they should be at this point in time. So this is another investor class that potentially is fuel later on or even now. These are the guys that people are asking me, who keeps buying? I'm like, well, it's the people that were underinvested. Some of these guys could lose their jobs, so they're forced to buy. And obviously and it's people that are short to get margin calls. Okay. Okay, the next slide is, I always like to throw in the VIX. Here's the VIX chart. This is just a daily chart. And I just want to point out, he hit 36 in late December. Now, we got all the way down to actually 14 at the close yesterday. It's not on this particular chart. This fuchsia pink line is the 200-day moving average. So we've come a long way in the market, and we've also come a long way in the VIX all the way back down. We lost a lot. We lost 50%. So if I go to the next slide, what happens generally when the market has had a huge up run in price, the VIX comes way down. This is generally what happens. When the VIX is down over 40% and the SPX S&P 500 rate of change is greater than 5%, which in this case, obviously, it was. We're up 14%, the rate of change. Here are some of the stats as we go forward. This is as of last week also. You'll notice some red in the first couple of weeks. And in this case, actually in summer of 2016, it actually was a decent, meaningful top. But you'll notice here, this 326.16 is in here, and also that November 1998. Again, those are those key time periods that I'm thinking that we are similar now. One of those 2 years, or 2009, where we had this explosive move off the lows, the VIX collapsed. Then you have a little bit of a pause. It might be a few weeks away, but it's not the time to get overly aggressive on the long side. But I wouldn't, if you're trading for shorts, you're going for singles and doubles. You're not expecting a home run from here. I don't believe we're going to go straight down and back into a new bear market and retest the lows anytime soon. But I would expect, just to clarify here, the 1 week forward returns in general, on average, the S&P was down a little, like 73 basis points, and it was down 60% of the time. 2 weeks, the number, it was more bullish. We were up 60% of the time. Longer term, it's kind of, it gets a little bit choppy here. I like this slide sometimes. This is also this particular column, because it shows you what happens within 12 weeks of the signal. And you'll see there is a drawdown, usually 2.71% on average, and the median is 1.94%. So using 27.75, take a couple percent off there. Expect that to happen over the next few months, before potentially we get into this next up leg into the summer. Okay. Here's another indicator. It's a similar idea in terms of the VIX. This is just the VIX closing under 15 for the first time in 4 months. And you'll see that it actually, 2 months out, the S&P, once it goes below 15 for the first time in 4 months, these are the results. And so there is in 1 and 2 months out, there generally is some problems. The market's down most of the time. This is kind of statistically significant, I'd say, a couple months out. But longer term, the 1 year later, the market was up 100% of the time. And again, it was probably in the mid 2700s, 2770 when this was triggered. So over the next couple of months, I would expect a little bit of a pause, and then we can go back off to the races for at least an attempt higher, and we'll get to where I think maybe a second. Next slide. Oh, this is another one of my favorites. Corporate buybacks. Okay, you can see the corporate buybacks exploded in 2018, and we almost had $1 trillion worth of buybacks. This chart wasn't updated. It actually was closer to $1 trillion, which was an all-time record. A similar amount is expected this year. So this is one investment group. People are like, who's been buying? Well, it's these guys. These guys are basically the larger investment class that is buying. And it's good and bad. It's good that they're going out and buying, but they're longer term, it might not be a great sign, because if you look over here on the left, when we had the peak in buybacks back then, it turned out to be the end of the bull market. So on one hand, it's good. On the other hand, it's not so great. We're probably obviously we're some point in late cycle. Late cycle means it could last a year, a month, a year, 2 years. But that's something to watch. Also, I would say if there is legislation on buybacks that corporations can't buy back more stock, that would be a pretty big negative, and the market would not like that at all. Okay. Okay, next chart. Okay, so this can help you map out a little course of action. This is corporate buybacks. This isn't a recent chart. I got it several months ago, but it applies because it basically what it tells you is every week during the year, what do you expect in terms of corporate buybacks? Corporate buybacks are seasonal because there's a quiet period. Corporations cannot buy their stock back other than on automated plans, but discretionary buybacks can happen 5 weeks before they report earnings and up to 3 days after. So there is a very predictable pattern, and you can invest on that. You can actually take signals off of when is the lowest buybacks, when do I expect the buybacks to be the weakest, and when do I expect the buybacks to be the strongest. And especially now, in 2018, we saw how important that they were. In 2019, they're just as important. You want to have something like this. Now, on this particular chart, I'm not looking at these tan ones because these tan ones, and they're cut off here because he didn't have the data updated, but those tan ones represented, there was one-time tax gains that corporations got. And some of them bought stock with that. So it was a little bit artificial, especially initially. What I would follow is the blue buybacks, because this is over a decade or two, these weekly bars, right there all the way through. And you'll see the buybacks start to pick up as you go on. Basically, after companies report, you'll see buybacks will generally, for example, buybacks are actually going to crest in April, early April, right here, end of June, early July, right here, end of September, early October, right here, and then right at the end of the year, you'll see a huge drop off as corporations aren't buying. Some of them are on vacation, but also it's because of the blackout period. And it's what I like to do is last year the best signals were all if you bought in late June, early July, and rode that out into late August or September, you did very well for yourself. So what I want to do in the next slide is show you what happened. These are the when the buybacks actually were the least. So what happens is the market front runs it. The market says corporations are not going to be buying stock every day. So that demand is not going to be there. So what you want to do is when you're selling off into that, it's generally been a great time to buy. Early April, this is a weekly S&P 500 chart from last year. And here's also late June, early July, great buy. This one, not so much, but also we happen to be rallying right into it. So I wouldn't necessarily get that bullish into that time period. But this one, again, when did we make the low? Right at the last week of the year. When are the buybacks least? The last week of the year. So that's why it's important to follow this. And I post this stuff in the room, stuff like this, all year long. But I would save that particular slide or come back and look at it later. And actually, I got it from Zero Hedge several months ago. But it's been it's been very helpful to me to help map out intermediate and longer term trades, not day trades, but the position trades. It's been very helpful. Okay, so now let's get to okay. Basically, this is day 39 after our current rally has been 39 trading days long. The one that we've had since Christmas Eve. So what I like to do is, okay, look at past markets and where did they have problems? What did they do? When you had some of these breadth thrusts and some of those type signals, momentum, going back above the 200-day moving average, there aren't a ton of those signals. So you have to look way back to get them. But what happened? And so what I did right here was just mark day 39 after the October 1998 low, the 39th trading day. What happened? You'll notice that it actually was right in the middle of a little bit of a several week pause And I call this an ABC formation, basically consolidating the gains of the huge ramp that we had in October and November. And you'll notice it stopped once at this is the 20-day moving average. The purple one, that's the 10-day. The black one is the 5-day. The fuchsia pink one is the 200-day moving average. The blue one is the 50-day. So in 1998, in December, we had a little bit of a pause of that huge rally. If you look over here on the left, you'll notice that it actually paused roughly the all-time high from July of that year. So I like to look at past precedents and see what happened. So when I start to add things up, one reason why I think we may pause here is, okay, this particular move off the low, it really had a nice pause. One second. So yeah, it had a nice pause to refresh, and then it kept on its merry way to the bull market. But it stopped near old resistance. In this case, recently, probably 2,800 to 2,820 in that ballpark. When we get up there, expect some expect at least a pause. Okay, here's another one. Here's 2009, and folks that were around back then know that it was very depressed level. We'd just been through a pretty massive bear market, and it wasn't an easy time to buy. We kind of had actually a V bottom. Notice again, is day 39. What happened? Well, day 39, again, it's towards the end of this first, I want to call it ramp, first ramp up. It's the first multi-week pause. It was literally a few days out. So that again is getting me a little bit more defensive up here. I'd be hedging my longs up here if I was long, or shorting, considering shorting soon for a swing trade. Again, this is the 200-day moving average. At that point, didn't go above it. But you'll notice also I marked this side, this area over here on the left. That's in January. Again, we didn't quite get there, but it is a guide, rough guide. So that could be where we just recently got 2790-ish, 2800. It's a logical spot to have your first multi-week pause. And the truth is, you really, in general, after you had this up move, it really did slow down quite a bit for the next couple of months. So I just want to show you that other chart. That's another one. The breadth thrust was somewhere around here. Okay. SPX day 39 after the February 2016 low. Where were we? All right, so we actually, at that time period, we were already in a little bit of a small pullback. I call it A, B, C. Down, up, down. We got to the 20-day moving average, and then it made another move up. Notice where it stops. It stops right near previous resistance. Here's another A, B, C down. This one got all the way down to the 50-period moving average, and I think that's eventually coming, probably sometime in late March, early April. The stochastics in general currently are at a similar spot in general. So, we could easily see going into next week, my scenario is that we're going to go and touch the 20-day moving average like this one, and then potentially go up and take out and go test the 2810 level, maybe a little bit higher, and then have another more sizable time-wise pullback, and it probably, just like this one did, whatever low we get in the next week, we'll probably see again in a month or so. But that's kind of my base case for now. I think we're going to go down into next week, then have one more moonshot up, and then I think we're going to have this bigger correction sideways, just to regroup, recharge. You get to that, like I said back in the first slide, one of the first slides, it really tends to slow down between 2 months and 3 months, and then it picks back up. By the way, over here, you'll notice that we made new highs, but here's Brexit. That was a kind of a couple of day phenomenon, but it actually got down pretty good. Uh, some political event that could happen again. Maybe Brexit returns, or maybe it's something to do with China, or maybe it's Trump, or who knows? It could be a lot of things. But all three of those are kind of suggesting to me, 1998, 2009, and now 2016, that it's not going to be as straight up. Expect more pullbacks. Whatever style you've been trading now, you kind of want to want to change it unless you're just a scalper, an intraday. It's going to be similar, but it'll be more two-sided. You'll be able to sell rallies a little bit, and also buy pullbacks, still buy pullbacks, but be willing to sell some rallies. This move right here would be it's very tricky considering what we've been had recently. Every pullback essentially we've had in 2019 is stopped right at the 10-day moving average, just like back here. They were all, and I was posting that in the room. It was a 10-day moving average. I posted in the room. Here's the 10-day. Look for it to bottom right around the 10-day MA. When you have these explosive thrust moves, that's what happens. It doesn't let anybody in. It just has these small pullbacks until finally you run out of a little bit of steam. As you get towards previous highs, say 2800, 2810, as you approach those, the people that didn't sell up here that just want to break even, they're sellers. It's just a logical spot. Then this red line, that's the 20-day moving average. You want to start it's probably going to break it, just like this one did, by a little bit sometime next week. But there's a lot of chop in here, so just be careful. You might get whipsawed around if you have unless you have an idea that something like this may be in the works. Otherwise, you can buy the pullback and just hold it through a little bit of this chop, and or hedge with SPX puts. Excuse me, looking for higher highs in the weeks ahead. But that's my story in general in terms of what analog is going to play out. This one kind of makes the most sense to me. Okay, next slide here. Oh. This is along the same lines. This is a Goldman Sachs piece, and if you look at it, let's see, it shows the historical path of the market after it sells off by 20% within 3 months. So you have a quick sell off of 20%, and it happened 10 times since World War II. What happened next? The next thing that happened is it trickled up a little bit longer, and then it went into this multi-month. These are months down here. It went into multi-month pullback trading range. Buy the dips, sell the rips, and I'd expect the same thing here. It should set us up, as I said, probably in sometime in May, in June for sure. By June for sure, we should be ramping up and starting to move back up, and maybe attempting to recapture the 2800 level. If we don't, I'm assuming we're not going to go straight up right now and take it out. But it's possible we go we just keep going right to the all-time highs right now. I don't think so, but I've been wrong before. But this is a good chart. It gives you a good roadmap. Okay, next slide. Okay, are we in a bull market or a bear market? I can't say with authority which one we're in, but I can show you a couple slides that will give you an idea where we might be. Okay, consumer confidence. I like this chart. It's a good chart because it helps you understand that when consumer confidence is very high, it's actually not a great time to invest. It's actually a very bad time to invest. The Fed is usually tightening or has been tightening, and it's usually at the end of an economic cycle. So we've had this blip down. Consumer confidence fell off a cliff in December. It's ticked back up, I believe, in February and January, but um, it came down to this, in this case, 120 level. Why do I say what's important about this 120 level? I have no idea. But what I will say is that for the people that have the 1998 mentality that this is kind of we just had a pause in an ongoing bull market, this adds some, this goes towards that argument. Maybe this is just a blip down caused by the Fed being too hawkish, as well as is obviously the trade situation and the lack of liquidity at the end of the year and the algorithms and forced sales by hedge funds. Maybe that's all we're going to get, and then we're going to go to all-time highs sometime in year 2000. Actually, we hit all-time highs before then, but we hit them in early 2000. Excuse me, early 1999. But we topped out in consumer sentiment. Looks like that was in mid 2000, early 2000. So maybe we're just getting a pause, but there's also a possibility that we're actually already in the throes of a bear market. If you look at, oh, I can't, the bottom is, you can't really see the date, but the 2007 bull market, the consumer confidence only got to 111. So we went way above the top in that bull market. So it's possible that there is a chance that that was it. And we could be in some sort of a deeper bear market that takes several months or years to get through. I'm not in that camp right now. I think we're going to rally. I think we're going to probably test the highs. But I don't, at the same point, I don't know that I'll have to look at the positioning and things like that. I'm not sure that we're going to go up 30% above the peak we saw in 1998 or 3,800 in the S&P. I'm not ready to say that for a couple reasons, but one of them is on the next page. Well, where did that chart go? Let's see. Oh, it's not. Let me see if it's not in here. Well, I'm going to show you the next chart. Okay, so this is McClellan Summation Index. Earlier in the week, it hit 1120. That's a really high number. It doesn't hit that often, once every 3-4 years, and we hit there last week. Again, it's a breadth indicator. You can type it in the internet and you can get a better description of it, but it's basically saying that there's broad participation in this rally so far. And the other thing that I want to add to this particular chart is if you look at the bear markets in 2007 to 2009, you'll notice this thing never got above 500. Even early on, these bear market rallies, even when we made a new high, that one we didn't even get, this thing did not, it wasn't a broad-based rally. The same thing in year 2000. From 2000 to 2003, we never got even above 1,000. And we recently hit 1,120. So that gives me a clue that there's a good chance that we are not in a secular bear market, and there's a good chance that we're going to go potentially retest the highs, because all these other times we got to 1,000, above 1,000, 1,100. We were in just after the kickoff phase or in the middle of a serious move up. So this is a healthy market. That's a good sign. And that's a longer term, I would say that's a vote for the bulls, and that there's a chance to at least test the highs, 2940, potentially get through those. And let's see. Goldman Sachs does a probability model. whether or not there's going to be a bear market. The orange areas shaded are when we went into a bear market. Oh, actually, those must, yeah, were part of a decline. Yeah, 40% declines. So if you look over here to the left, say that's like 80%, 80% chance you're gonna have a meaningful pullback or bear market on a longer term basis sometime soon. And it worked in 2000. We got to these levels, and we did. We went into a pretty bad bear market. It If you'll notice here in 2000 and late 2005, early 2006, we got up to these levels. Notice it took a while for the market to actually slow down because we didn't get into a bear market until late 2007. So this signal can be early, and I do think it's going to end up being early. Again, even though we're way up here, there's an 80% chance of a bear market in the next couple of years. You know, you got to time it properly, or you'll end up missing the mover, not being long or lose money on the short side. I also want to show you, here's 1998. So 1998, this was much lower. So it only got up to a little under 70% chance that we're going to get into a bear market soon. So that, just looking at that particular thing, that leads me to believe that if we do make a new bull market high, it probably doesn't have as much room as the 1998 pullback and rally to 31% to new highs. I think it says the likelihood is that there's not enough fuel to take it to 3,800. There is a good chance, however, that retest of the highs, take out the highs, even low 3,000s. I think that's possible. But the first thing I'd say with a decent amount of confidence, I'd say you got to say there's at least a 2/3 chance, 66% or better, that we're going to see the old highs, 2940, by the end of the summer. Just looking at those prior years, 1998, 2009, 2016, I think there's a good chance after we have a little bit of a consolidation that we do see that. So I know I went too far. I'm just about done, and then if anybody has any questions, I'll take those. I'm not sure who's next and at what time, but these guys will tell me. In any event, so basically the summary is 3 to 12 months out. The picture looks very good. We had the Deemer breakaway thrust signal that I talked about. We also had a 15% rally off the lows that regained the 200-day moving average. We also had the NDX, 90% of its stocks went above its 50-day moving average, went above their 50 moving day average. That was very bullish longer term. 1 year out, it had a 100% track record. Retail investors remained skeptical during this rally. The Ameritrade chart, the mutual fund outflows and lack of flows on the way back, and commercial hedgers, they were actually buying. Instead of hedging their portfolios, they were actually long futures contracts. Very unusual, very rare, and it's always been a bullish sign. Hedge funds, just like I mentioned earlier, they are basically underweight where they should be on a historical basis. They're underperforming their bogeys, their benchmarks. So those guys are chasing, and the retail investors and the hedge funds are the ones that have been buying the last couple of weeks to try and catch up. The negative in the near term is that the CNN fear greed indicator is above 80, which means that on a near term basis, it's a little bit, it's extended. It's overbought. We're also, on this, I put 37, we're now 39 trading days from the December 24th low. You saw that from those other 3 years that I posted, that was generally the area that you started to see problems. One made it to 40 or 41, the 2009. So we're kind of near the end of this whoosh move up or this explosive move up in my view, especially that because we're also at the near previous resistance levels. And also this factor, the VIX hit 36 in December. Now it's at 15, closed below 15. Rapid decline. And then the last one, obviously the 2810, talked about that. And peak stock buybacks for this quarter, actually next week is the peak. And then they're going to drift down until, in, 1 second, until late March, early April. Then they're going to pick up again. Powell put, reinstated. He caved to Trump, and not only that, the economy did slow down quite a bit, and he really wasn't on the ball. So major pivot by the Fed. He's happy. That's it. Here's some follows. Follow all these guys. Some of these guys, Steve Depp, he gave me that the VIX chart. Troy Bombardier, great stuff too. I would try and write these down. I'll keep the slide up. He he sends out a weekly. Both those guys send out a weekly newsletter if you want to get it, free. Sentiment Trader, talked about him. Awesome. And Urban Carmel, he's good. Odd Stats, these are all Twitter guys, and Danny I put on the bottom too. Take those down. You'll save or make money by following these guys. They're good longer term guys. Some of them do intraday, but most of them are position traders like me or longer term even. Troy Bombardier, longer term, but great stuff. Free. For now, I'm sure he's going to start to charge at some point. And that's it. Anybody have any questions? I can go back to any of the slides too. Just type in the box if anybody has anything. There shouldn't be music in here. Let's see. John or Danny, anybody around? Thanks, Julian and Gil. I was a little bit hurt in the beginning. I was a little bit nervous because right before, as I said, I had I had a major internet problem. I lost my internet, so I got nervous and I was like a little bit like, oh boy, and trying to follow market a little bit also. But I hope you guys got a lot out of it. I went through it pretty quick. John tells me there will be